Right now, as you're watching this video, millions of silver investors are preparing for what they believe is the most important event of the month, the Federal Reserve meeting. Tomorrow, all eyes will be on Kevin Warsh. Every financial network will analyze every word. Every headline will focus on interest rates. Every trader will be waiting for a signal. But here's the problem. Most people are looking at the wrong event, because while everyone is focused on what happens tomorrow, almost nobody is paying attention to what happens 8 days later. And that could be the event that actually changes the direction of silver. In fact, there is a very real possibility that tomorrow's Fed meeting creates the headline, but June 24th creates the move. And if that happens, silver holders who understand what's happening now could have a major advantage over investors who are only watching CNBC headlines and social media reactions. Because beneath the surface, underneath the daily price action, behind every red candle and every green candle, the silver market is sending signals that are becoming increasingly difficult to ignore. Signals that suggest the next major move may already be forming. Now, before we talk about June 24th, before we talk about COMEX, before we talk about physical silver, let's talk about the Federal Reserve. Because whether you're bullish or bearish, tomorrow matters. Not because investors expect a rate change. Almost nobody expects that. Markets have largely priced in a hold. The real question is what Kevin Warsh says next. Will he sound hawkish? Will he sound neutral? Will he hint at future tightening? Will he acknowledge recent inflation improvements? Those answers matter because silver remains one of the most rate-sensitive assets in the world. When investors believe interest rates will stay higher for longer, the dollar usually strengthens. Treasury yields often rise, and silver frequently comes under pressure. But here's what many investors forget. Markets don't move based on what happens. They move based on the difference between expectations and reality. And that distinction is everything. Because if traders already expect Warsh to sound tough, and he simply delivers what everyone expects, that may not be enough to push silver significantly lower. In fact, some of the biggest rallies in financial markets begin immediately after a widely feared event passes without creating additional fear. Think about what happened earlier this year. The anticipation was often worse than the event itself. The fear created the selling. The reality created the recovery. And that's why tomorrow is so important. Not because rates are expected to move, but because expectations are already sitting at extreme levels. Right now, investors are trying to answer one question. How aggressive will Kevin Warsh be? And while that question dominates headlines, a second question is receiving almost no attention. What happens if physical silver demand remains strong while paper traders are distracted by the Fed? Because that's where the story becomes interesting. Very interesting. You see, silver isn't just a monetary metal anymore. It's an industrial metal, it's a technology metal, it's an energy transition metal, it's an AI metal, it's a defense metal, it's a solar metal, and every one of those industries continues consuming enormous quantities of silver, regardless of what happens at a single Fed meeting. That's why long-term investors are watching something very different. They're watching inventories, they're watching deliveries, they're watching physical supply, and most importantly, they're watching June 24th. Because June 24th is first notice day for the July silver contract. And historically, when large delivery months approach, the market begins paying close attention to the relationship between paper silver and physical silver. Now, if you're new to the silver market, here's why this matters. Every futures contract represents silver that can potentially be delivered. Most contracts are closed before delivery, but some stand for actual metal. And when delivery demand increases during periods of tight supply, traders begin asking a very important question. How much silver is actually available? Not theoretically available, not paper available, physically available. And that question becomes even more important when inventories are already under pressure, because once investors begin focusing on physical availability instead of paper pricing, market psychology can change very quickly. That's exactly why the next few days matter. Tomorrow is the Fed. June 24th is first notice day. And between those two events sits one of the most important periods silver investors have faced all year. Because if Warsh sounds hawkish tomorrow, silver could experience short-term volatility, no question about it. But if physical demand remains strong, if deliveries stay elevated, if inventories continue tightening, the story could become much bigger than a single Fed meeting. And that's what we're going to explore in this video. We're going to look at the 5 possible outcomes. We're going to separate short-term fear from long-term reality, and we're going to identify the exact levels that could determine whether silver heads back toward $60 or begins moving toward levels that very few investors currently expect. Because one thing is absolutely certain. The next 7 days could be among the most important 7 days of 2026 for anyone who owns silver. And by the time this week ends, the market may look very different from the one you're looking at right now. The reason the next few days matter so much is because the silver market is now being pulled by two completely different forces at the same time. One force is financial, the other is physical. The financial force is the Federal Reserve. Interest rates, treasury yields, the dollar, risk sentiment, everything Wall Street talks about every day. But the physical force is something entirely different. It doesn't care about headlines, it doesn't care about press conferences, and it doesn't care what television analysts think silver should be worth. The physical market only cares about one thing. Can buyers get the metal they need? Because if demand continues exceeding available supply, eventually the physical market begins overpowering the paper market. And that is why so many experienced silver investors are paying attention to inventory trends right now. Think about it this way. Imagine a grocery store. Every day customers walk in and buy food. If trucks keep delivering fresh inventory, there is no problem. Shelves stay stocked. Prices remain relatively stable. Nobody worries. But what happens when deliveries start slowing down while customers keep buying? At first, nothing dramatic happens. Most people don't notice. Then certain shelves start looking thinner. Then popular products disappear. Then buyers begin competing for whatever remains. Eventually, the shortage becomes visible. And once it becomes visible, behavior changes quickly. People buy more. Suppliers raise prices. And the imbalance accelerates. The silver market can work the same way. Not overnight, not instantly, but gradually. And that gradual process is exactly what many analysts believe has been happening beneath the surface for years. Because while silver prices have experienced enormous volatility, one thing has remained remarkably consistent. The world keeps consuming huge amounts of silver. Every solar panel needs it. Every advanced electronic device uses it. Artificial intelligence infrastructure requires it. Data centers require it. Military technology requires it. Medical equipment requires it. Electric vehicles require it. And unlike gold, much of that silver is not stored forever. A significant portion gets used, consumed, embedded inside products, removed from the market, which creates a challenge. New supply has to continually replace what disappears. And that replacement process isn't always easy. Mining projects take years to develop. Permits take time. Production expansions take time. New discoveries take time. Demand can rise much faster than supply. That's one reason why silver has recorded multiple consecutive years of market deficits. In simple terms, more silver has been needed than has been produced. Now, a deficit doesn't automatically mean prices explode. If it did, silver would already be much higher. Markets are more complicated than that, but persistent deficits create pressure. Pressure that builds over time. Pressure that becomes increasingly important whenever major delivery periods approach. And that's where June 24th enters the picture again. Because as first notice day approaches, investors start paying closer attention to whether physical metal continues flowing smoothly through the system. Most delivery months pass without major drama. That's important to understand. The majority of the time, markets function normally. Contracts settle. Deliveries occur. Business continues. But traders don't just watch for disruptions. They watch for signs of stress. Small signs, subtle signs, changes in inventory movements, changes in premiums, changes in physical demand, changes in delivery requests, because markets often reveal important information long before headlines do. And that brings us to another major factor many investors are overlooking: China. While American investors focus heavily on Federal Reserve policy, China continues consuming enormous quantities of silver through manufacturing, technology production, renewable energy expansion, and industrial growth. The country remains one of the largest players in the global silver market, and whenever demand from major economies remains strong during periods of tightening supply, traders pay attention, very close attention, because demand isn't coming from just one source anymore. It's coming from multiple directions simultaneously. Solar energy expansion continues. Artificial intelligence infrastructure continues growing. Electric vehicle production continues expanding. Advanced electronics continue requiring silver's unique conductive properties. And every one of those sectors competes for the same metal. Now combine that with another reality. Many silver mines don't actually exist primarily to produce silver. Silver is often a byproduct, which means increasing silver supply isn't as simple as deciding to mine more silver tomorrow. Production depends on broader mining economics, and that can limit how quickly supply responds when demand increases. This is one reason silver can remain quiet for long periods and then suddenly move with incredible speed. The underlying pressure builds slowly, the price response happens quickly, and that's exactly why the next several days are so important. Because the market is approaching a moment where two competing narratives collide. Narrative number one says higher rates are bad for silver. A hawkish Fed strengthens the dollar. Higher yields pressure precious metals. Silver falls. Simple. Narrative number two says physical fundamentals remain strong. Industrial demand remains strong. Supply challenges remain real. Inventory pressure remains present. Silver eventually rises. Also simple. The fascinating part is that both narratives can be correct at the same time. Silver could experience short-term weakness while long-term fundamentals continue improving. That happens more often than many investors realize. Markets frequently move in the opposite direction of fundamentals before fundamentals ultimately win. And that's why experienced investors spend so much time separating short-term volatility from long-term trends. Tomorrow's Fed meeting may determine sentiment, but it won't determine whether the world suddenly stops needing silver. It won't stop solar installations. It won't stop AI expansion. It won't stop electronics manufacturing. It won't stop industrial consumption. Those trends continue regardless of what happens during a single press conference. Which brings us to the question every silver holder wants answered. If the Fed creates volatility tomorrow, how low could silver go? And if the market focuses on physical fundamentals instead, how high could silver move during the second half of 2026? Because there are several realistic scenarios. Some are bearish, some are bullish, and one of them could produce a move that catches almost everyone off guard. In the final part of this video, we're going to break down those exact scenarios one by one. We'll identify the key levels every silver investor should be watching. We'll discuss what a hawkish surprise would mean, what a neutral outcome would mean, and what could happen if the market suddenly realizes that the biggest story in silver isn't the Fed at all. It's the growing gap between physical demand and available supply. And if that realization begins spreading through the market over the next week, the move that follows could be much larger than most investors currently expect. The biggest mistake silver investors can make over the next few days is believing that only one outcome is possible. Markets rarely move in a straight line, and they almost never reward consensus thinking. Right now, the consensus believes tomorrow's Federal Reserve meeting is the entire story. But history shows that when everyone is watching the same event, the biggest opportunities often emerge somewhere else. That's why I want to walk through the three most realistic scenarios from here. Not predictions, scenarios. Because successful investors prepare for multiple outcomes instead of becoming emotionally attached to one. Let's start with the bearish scenario. In this outcome, Kevin Warsh delivers a much more hawkish message than markets expect. He emphasizes inflation risks, he avoids discussing recent improvements in energy prices, he signals that rates may need to remain restrictive for longer than investors currently anticipate. The dollar rallies. Treasury yields move higher. Risk assets come under pressure, and silver experiences an immediate sell-off. In that scenario, a move back toward the mid-60s becomes possible, not because silver's fundamentals suddenly changed, not because industrial demand disappeared, not because physical supply improved, but because financial markets would spend several weeks repricing interest rate expectations. That would create fear, volatility, and likely a wave of emotional selling. Now here's the important part. Even in that bearish scenario, the long-term silver story does not automatically disappear. Many investors make the mistake of confusing a correction with a collapse. Those are not the same thing. A correction is a temporary repricing. A collapse is a broken thesis. And unless something fundamentally changes regarding industrial demand, supply deficits, and physical consumption, the long-term thesis remains very much alive. Now let's move to the second scenario. The neutral scenario. This is probably the outcome many institutional analysts currently expect. Warsh sounds firm, but not aggressive. The Fed holds rates. The statement contains no major surprises. Markets initially react with volatility. Silver experiences sharp moves in both directions. Financial media declares victory for one side and then the other. But after the dust settles, the market realizes very little actually changed. And that's where things become interesting. Because when a highly anticipated event passes without creating a major shock, investors often redirect their attention elsewhere. Toward economic data, toward inflation, toward physical demand, toward inventory trends, toward delivery activity, and most importantly, toward June 24th. If that happens, silver may spend a few days consolidating before beginning its next major move, not because of the Fed, but because investors start focusing on physical market fundamentals again. Now let's discuss the third scenario, the bullish surprise. This is the scenario very few people are talking about right now, not because it's impossible, but because fear tends to dominate financial conversations. In this scenario, Warsh acknowledges improving inflation trends. He recognizes the impact of lower energy prices. He avoids signaling future tightening. And markets conclude that the worst fears surrounding monetary policy were overblown. The dollar weakens. Yields ease. Precious metals attract fresh buying. Silver breaks through key resistance levels. Momentum traders return. Institutional capital starts flowing back into the sector. And suddenly, the conversation changes. Instead of asking how low silver can go, investors begin asking how high it can go. That shift in psychology is incredibly powerful because markets are driven by expectations. And expectations can change much faster than fundamentals. If silver begins attracting momentum again, moves that once seemed impossible can happen surprisingly quickly. That's why experienced investors watch key levels so carefully, not because charts predict the future, but because they reveal where psychology may change. A breakout above major resistance attracts attention. Attention attracts capital. Capital attracts momentum. And momentum can accelerate trends far beyond what most people expect. Now, regardless of which scenario unfolds, there is one fact that every silver investor should remember. Tomorrow is important, but it is not the finish line, it's the starting gun. Because once the Fed meeting is over, attention immediately shifts toward physical market developments, toward delivery activity, toward inventory movements, toward industrial demand, toward everything that continues shaping the silver market long after tomorrow's headlines disappear. And that brings us to the most important takeaway from this entire video. The next 7 days are not about predicting a single outcome. They're about understanding the range of possibilities. If silver falls, you'll know why. If silver consolidates, you'll know why. If silver rallies, you'll know why. And that knowledge gives you an advantage over investors who react emotionally to every headline. Because while most people are chasing the news, the smartest investors are watching the bigger picture. They're watching supply. They're watching demand. They're watching inventories. They're watching deliveries. And they're watching whether the physical silver story continues strengthening beneath the surface. Tomorrow, Kevin Warsh will speak. Markets will react. Headlines will explode across the financial world. But once the noise fades, the same question will remain. Can the world continue consuming silver faster than new supply can replace it? Because if the answer to that question remains yes, then the long-term story may be far bigger than any single Fed meeting. The next few days could be some of the most important days of 2026 for silver investors. And by this time next week, we may have a much clearer picture of where this market is headed next. So stay alert, stay informed, and most importantly, don't let short-term noise distract you from the long-term story. Because sometimes the biggest opportunities appear when everyone else is focused on the wrong thing. If you enjoyed this analysis, subscribe to AgJohn Silver Update and join us as we track every major development in the silver market, the global economy, and the forces shaping the future of precious metals. Until next time, take care, stay prepared, and keep your eyes on silver.